Hi, everybody, and welcome back to yet another cracking installment of the Matt Brown Show. This is the Private Placement Perspective series where we're talking about the world of investing and venture capital and all sorts of exciting things. With me on the line from Cadron Capital is Jeff Standridge. Jeff, welcome to the show.
Hey, great to be here, Matt. Thank you so much.
Privilege is all mine, man. Great to have you here. So for our viewers around the world, Jeff, who haven't heard about Cadron Capital and our conduct and all this kind of cool stuff, you're doing a lot of different things in the space. Why don't you quickly give us the kind of elevator pitch to Cadron Capital and, you know, how you got your start in the world of venture capital?
Sure. So Cadron Capital Partners, cadroncapital.com is an early stage venture fund really focused on companies that are in that Series A gap between seed and Series A, or maybe early Series A. We got into the venture capital world because in Arkansas, where we're located, there's not a lot of capital. Venture capital gets funneled to our state, and we knew from our work as entrepreneurial support folks. So we run a couple of entrepreneurial support organizations called Startup Junkie and The Conductor, arconductor.org. We come across quite a few deals, both in our state and in the surrounding states that are really kind of flyover types of states. And we knew there were opportunities. And so we started out probably about 2015, raising small funds and kind of accelerating those funds over time between Jeff Amorine and Brett Amorine, my co-general partners. Between us, we've had about 5 different funds. And we're now in kind of our third installment of Cadron Capital Partners.
Congratulations. And when you cut a check, what's a typical check size look like, and who are you cutting checks to? Is there a focus for you?
Sure. So we're industry agnostic, really. I mean, we invest in companies that we feel like that we can help through our networks or our expertise. So I come from a pretty vast background as an entrepreneur for a number of years in a data analytics company, publicly traded company with global experience, companies that acquired and managed and or built all over Europe, Asia, North America, South America, et cetera. And also have a pretty strong healthcare background. My co-general partners have a lot of experience in logistics, AI, retail supply chain, being in Northwest Arkansas with the Bentonville headquarters for Walmart, JB Hunt, and Tyson Foods. And so our network of investors also bring other industry expertise and other subspecialty expertise. And so if we feel like that we can help these companies with our network, our expertise, our relationships with certain potential clients like large enterprises, then we're looking for those. And then secondly, we start looking at the team, obviously, the products and services they have, how big's the business problem that they're solving. And our earlier funds, we were writing checks in the $100,000 to $150,000 range. With the Cadron Capital Partners fund that we're managing now, more like $250,000 and up is what we're looking at.
Okay, and excuse me, I'm assuming they need to be revenue generating, or can they come to you with an idea?
So they can come to us with an idea for some entrepreneurial support. But we're going to be reticent to write checks. We've done that in some of the earlier iterations of our funds. Right now, we're really looking for a strong team with a big market that they're generating $1 million a year of annualized revenue, maybe $1 to $2 million with about a 50% year-on-year growth rate, high gross margins, and a really big market opportunity.
So the dream.
The dream. That's right.
Bring me the dream, baby.
Bring me the dream, baby.
Very cool, man. So look, what makes you guys special or different to, say, other VC firms out there?
Yeah, so we're small, obviously, and we write smaller checks. We don't expect to be the lead on. There have been a couple of times where we've been the lead, but on specifically Arkansas-based funds, we're really focused on the flyover states. Not saying we won't invest in something from the coast, but generally we're focused on the flyover states. We think that there are bargains to be had in the flyover states. There are some great companies that are being created here. And then we get involved. We only do well if our funds do well. Our funds only do well if our portfolio companies do well. So we're constantly reaching out to our portfolio companies, if they haven't already engaged us, looking for ways that we can help them, whether it's an introduction. We also have functional expertise within companies. So I've got quite a bit of sales background, a lot of bit of financial background. So it's not uncommon for me to get on the phone and do some coaching with a chief revenue officer or with a sales leader, or maybe even to participate in some interviews at the request of the CEO or of his executive team. So we're not hands-on in terms of trying to control the ventures, obviously, because we're part of an investment syndicate generally. But we are here to help, and we'll leverage every ounce of expertise, relationships, networks that we have to try to help our companies grow.
Jeff, when it comes to the macroeconomics, obviously Silicon Valley Bank just imploded in about 24 hours, which seemingly, and there was a big stink around interest rates and what they did with their deposits, all this kind of stuff. Seems to me they were in a very uncertain time, post-pandemic and blah, blah, blah. How much does the macroeconomic situation play into your thinking when it comes to cutting checks to venture stage startups?
It plays into the thinking, and I would be foolish to say that it doesn't, but it doesn't carry the lead role. I mean, obviously with the Silicon Valley Bank collapse, if you want to call it that, or insolvency, or whatever you want to debacle, whatever you want to refer to it as, we immediately got on the phone and via email and started reaching out to all of our portfolio companies and saying, "Hey guys, where are you? What can we do to help? Is there anything going on?" So constantly plugged in with those guys. In terms of it being a showstopper, I don't expect it's going to be a showstopper. We may ask some different questions as we get ready to write checks. Tell me where you keep your cash. Tell me how you have your cash distributed across multiple institutions. And so it'll cause us to ask different questions and maybe some follow-on questions, but I don't see it really being a showstopper. These companies that we're looking to invest in are good companies, despite the fact that the banking system that they rely on, at least one or two players in the banking system at this point, let a group down doesn't necessarily mean that's going to infect the whole lot.
Mm-hmm. So when you are pitched, what factors you touched on a few up front, but are there some key factors that you look for when saying yes to an issuer or to a startup?
Yeah. So yes, absolutely. And I, by the way, I teach entrepreneurial finance to MBA students at the State University here. And so I always tell them that credibility just is if it's not king, it's certainly queen. People always say cash is king, and I say, yeah, and credibility is queen. And what I mean by that is I'm looking at everything. I'm looking at, every interaction I have with a potential portfolio company has the opportunity to either build their credibility with me and our investors and my general partners that work with us, either build their credibility or erode that credibility. So obviously we want to look at the fundamental soundness of the business problem they're trying to solve, of the solution that they have to solve, at the size of the market, whether there's domain expertise and functional expertise within the actual leadership team. Have they had experience before in growing a successful company or generating a successful exit? Traction with investors and or traction with revenue. Certainly all of those fundamental kinds of basics. But I'm also watching, do I want to be in business with this gentleman or this lady? Would I want to go have dinner with them? Would I want to go have a beer with them? Is this somebody that I really feel like I can grow to trust? How they respond to the questions that I or my co-investors ask, and do they answer directly? Do they skirt the issue? Do they answer with a stock answer that really doesn't answer the question? When we decide that we want to go to due diligence, and I give them the call to say, hey, I've sent you an email that's got instructions for a Dropbox folder or an encrypted folder or whatever it is, and I want you to start loading. Here's the outline of what I want you to start loading. How long does it take them to actually get it all loaded? Does it take them 48 hours or does it take them 4 weeks? And I've had both. And every interaction, do they put all the information that we ask for in the folder, or do I have to keep going back and asking in the data room, so to speak? Do I have to keep going back and asking? So all of those little nuances are playing into how comfortable am I going to be writing a check over and above the fundamental analysis of the company and the opportunity.
Jeff, when it goes wrong, and obviously you get pitched a lot like most other VCs do, but when it goes wrong, are there commonalities that you see? Where does it go wrong in general? Like, is there something you would hang your hat on?
Yeah, there are several of those, and it really depends on the situation. I see a number of CEOs, founding CEOs, try to also be their chief technology officer. And in doing so, they spend way more money than they should on whatever the solution is because they try to manage an offshore team of technologists. I've seen that happen multiple times. So they're fearful of bringing in a CTO or a CIO and the equity they're going to need to give up to do that, or the salary they're going to have to pay to do that. By converse, I have seen a number of technical founders. So that's in the case of a visionary CEO who tries to be his or her own CTO. I've also seen the converse where you have a real technical CEO who really is the chief technology officer and who's really good at that, and they're not willing to actually bring in a CEO, a visionary, market-leading, market-moving CEO, somebody who can really sell and pitch investors and what have you. So that's one commonality that I see. Another commonality I see is they haven't done the work to really validate the market. They haven't done their customer discovery. They haven't quantified the market to the degree. They haven't done their customer discovery to qualify the market or to qualify that they've got the right product market fit between their product and the solution, their solution and the actual business problem they're trying to solve. That's probably the number two, I would say. And then number three is they take the lazy man's approach to quantifying the market, right? You see Mr. Wonderful rip them a new one on Shark Tank all the time where they say, well, the size of the market is $1 gazillion. And if I could just get 1% of that. No. I want to see, back to credibility, I want to see that you've done the work to build the assumptions. This is the price of our product. This is what the market's willing to pay. This is how many we think we can sell starting in month 3, because it's going to take 3 months of runway to actually start generating demand. And this is how much we think we can grow per month. This is when we'll bring in new salespeople. And so you have a build up to the actual pro forma, and you have a build up to the valuation versus the lazy man's approach, as I tend to call it.
Jeff, what's been the biggest success and failure in your venture capital history, and what would you put the difference down to?
I would say the biggest failure that I personally have had as a venture investor was, as I said a few moments ago, investing in a CEO who was trying to also be his own CTO and never got the product right and spent hundreds of thousands of dollars trying to do so until that portfolio company had to end up in a zero, shuttering their doors. The greatest success, we had a company that we invested in about 2016. They were in the financial services space. They saw a niche in the market during the COVID pandemic, and they exploited that opportunity in an appropriate kind of way, having to do with some of the federal CARES Act funding that was coming out and what have you. And they, the CEO, who's just a fabulous CEO, somebody I've ridden bikes with, whom I love to sit down and have dinner with, love to watch how he treats his team. And he told his team, look, here's an opportunity in this very unique market right now. I believe if we work around the clock for the next 90 days, we could probably generate, $5 million of one-time revenue. And at the end of the pandemic, he had generated over $120 million of one-time revenue. Now, it wasn't run rate revenue. It wasn't recurring annual revenue, but it was enough for him to write a check to all of his early stage investors at 10 plus times their original investment. And that was probably the greatest success. Now, we've got some other portfolio companies right now that haven't resulted in an exit that are doing fabulously. And I feel like there are going to be more of those, but those are two that I can really pin both of those examples, both the success and the failure, on the CEO and the way the team that he or she built, and both in these instances that he built, two different gentlemen, and the way they led those teams.
That's awesome. And so what's your advice to a founder looking to raise money from a venture capital today? Is there something that comes to mind for you?
Yeah, I would say, really know your numbers. Really know, and when I say numbers, really know the facts about your business is maybe a better way to say it. I'm going to ask questions about the size of the market. I'm going to be asking questions about, as are a lot of my peers, about what you've done to validate that you've created a product or a solution that solves a big enough problem that's going to result in a profitable business model. I'm going to be asking those questions. So show me the work that you've done the work. I'm going to be asking questions about your financial forecasts and your pro formas. Update your pitch decks. I mean, gosh, I can't tell you the number of times that I've gotten an executive summary in October, let's just say October of 2022, that was created in probably February or March of 22 that says we expect to be at an $800,000 run rate by the end of 2022. And so they send that to me that was created in January. We're now in October. Well, they ought to be at $650,000 or $700,000 a run rate, right? And I asked them, oh, well, we're at $250,000. Okay, well, why are you sending me an executive summary that says you're expecting to be at 850? That's no longer accurate. Are you expecting me not to ask that question? So it's back to that whole credibility thing. Pay attention to the details, do the work, and make sure that you're putting the best representation of yourself and your company in front of your investors.
That's really great advice. Jeff, we're going to take a quick break, and now a word from our sponsors. The Matt Brown Show is presented by Carafin, an investment bank that offers and supports direct private investments in U.S. operating companies. Over the past 20 years, investors have placed over $1.2 billion of private debt and equity in more than 100 companies through Carafin and its affiliates. Carafin leverages technology to empower its community of investors to deploy their capital far more efficiently than ever before and connects their community of engaged investors with worthy companies. Invest portions of your portfolio in direct private investments today. Visit carafin.com/Matt Brown Show for more. Jeff, I'm very curious to understand how you approach capital structures. So if the guys are doing $1 million in revenue per year, you like the team, they've been able to answer all your questions and things like that, do you price the round when you cut a check, or do you go with a convertible note or a safe? Where do you fall?
Well, generally, because of the size of our fund, the terms have often been set by a lead. Not always, but they've often been set by a lead. And we've invested in all three. So we've invested in safes, we've invested in convertible notes, and we've invested in priced rounds. It really just depends on the situation. I love each of those in certain scenarios. I will tell you that the first fund that I was part of back in 2015, excuse me one second, in 2015, it was probably May, we had our first company present to us a safe. And we had some pretty sophisticated investors sitting around the table, and we were like, whoa, what is this thing you call a safe? Simple agreement for future equity. That doesn't fit. Oh yeah, it's open source. It's from the Y Combinator. Yeah, open. Whoa. No. And so we didn't do anything there. So fast forward to another fund that I'm in August. So just a few months, they came and pitched to the fund that I was an investor in the first fund. I was a founder of the second fund, and they came and pitched to us in August, and we ended up writing a check to them in a safe. So fast forward now 7 years, that we've already taken a partial exit from that, and they're getting ready to have a liquidity event, which is going to result in probably a 10 or 12x what our original investment was. So it actually worked out very, very well. But interestingly, by January of 2016, certainly by middle of the year of 2016, 75% of all the deals we were seeing were coming to us as safes. So just a year prior, we had seen our very first one. Even 10 months prior, we'd seen our very first one. Now the majority of the funds of the opportunities we're seeing are safes. So, don't necessarily dislike them. Very comfortable with them. Convertible note, like the concept of having the coupon attached to it, right? That's the real difference there. The promissory note and the liquidation preference that it has versus a safe or priced round. But then, love to see priced rounds as well. So it really just depends upon the situation.
Jeff, why do you think safes were adopted so quickly? Because it's kind of like it came out of YC, and then it was like, oh, everybody's using the safe. Like surely there was standardization before then, to do the same job. Like why do you think the safe was adopted as quickly as it was?
The hardest dance to do in small funds like ours, where you maybe have some first-time accredited investors, the hardest dance to do is to really figure out the valuation component and get comfortable with the valuation and to negotiate the valuation. And so I think SAFE agreements, SAFEs really kind of minimize the significance of that, right? And it made logical sense to say, okay, the valuation is going to be determined at the next liquidity event, or under these circumstances when the company has a better run rate, a more consistent revenue stream, et cetera. So I think that probably had a lot to do with it. Certainly in the flyover states where you have some people who maybe are venturing into this space for the first time, or maybe not have a lot of experience. I think that probably had a lot to do with it. Mm-hmm. Just complexity.
Yeah, I got you. I'm all up for standardization, to be honest. If it's something that's accepted, great. I think 30 years ago, there wasn't that luxury. I think people were still paying lawyers and everyone doing their own thing their own way. So I'm all up for standardization, man. Costs are real.
Sure. Well, and this open source idea, let's leverage, don't reinvent the wheel, right? If someone else has done something that makes sense, then let's do it.
Mm. Jeff, I want to change gears. Let's just say one of your issuers, one of your startups that you've backed, someone taps them up and says, look, we want to acquire you. Strategic acquisition, or maybe there's something else happens down the line, whatever. How do you evaluate an exit? Like, do you go and just advise the startup, or do you say, you guys decide, we'll be happy with whatever you want? Like, when an event like that, or a potential liquidity event, raises its head, how do you approach and evaluate an exit opportunity?
Well, by the time that occurs, because of the previous description that I provided of how we are kind of hands-on in a very personalized way with the portfolio companies, they're generally reaching out to us to advise. And they're telling us, we've got this going on. We'd like your perspective on this. We don't generally say, hey, whatever you decide, because there have been a couple of instances where we've had what we call a cram down, where what was decided didn't fare very well. We didn't fare very well in what was decided.
Yeah. So Jeff, what actually keeps you awake at night when you think about the world of venture capital?
In the flyover states, and certainly in the state of Arkansas, it's the availability of venture capital. When the market is flying high, when the real estate market is strong, investors many times will say, I don't want to really take the added risk. They may not understand portfolio theory, or maybe they do understand portfolio theory that says, out of 10 investments, 2 or 3 are going to be heroes, 2 or 3 are going to be zeros, and the ones in the middle are going to provide some kind of a marginal return, hopefully. You really make your fund on those 2 or 3 heroes, or your investment if you're an individual investor. And so the availability of venture capital, the sophistication of angel and venture investors, and educating kind of the market is what we kind of have to do in some of the smaller states in the middle of the country. And so the availability of that money is really what concerns me most. I think the accredited investor requirement that the SEC has is archaic and needs to be abolished, quite frankly. And so I think that compounds the issue. But I also believe that what's happened recently with Silicon Valley Bank, for instance, and the inflated valuations on the coasts of coastal startups is probably going to drive more money to the middle America. That is at least my hope, and maybe a solution to what keeps me awake at night.
Jeff, why do you say that the accredited investor requirement by the SEC is archaic?
Well, so I can go and start an LLC with my buddy and start investing in real estate, or can start a company and liquidate my 401k to actually start that company, and not have to comply with any types of SEC accreditation requirements. But for a venture investor or an angel investor, I have to substantiate that I have, or have to self-acknowledge that I have $1 million of net worth, excluding my home, my primary residence, or $200,000 a year of annual income for the succeeding 2 years. And, in a situation where, $200,000 on the West Coast or the East Coast is a completely different level of buying power than $200,000 in middle America, say in central Arkansas. And so number one, it's an unlevel playing field. Number one, the middle America, the flyover states are already being, I don't like to use the word robbed. That sounds like we're a victim, and I don't want to say that, but we're already being disadvantaged by the flow of coastal funds. And then you throw the accredited investor requirement, which creates an unlevel playing field in terms of revenue, household income and net worth. I just think it's a confounded and biases against the flow of funds to the right deals.
How do you find accredited investors? What have you learned about tapping up that particular segment? Because there's obviously family offices, institutional capital and stuff like that. But, from my conversations with a number of VCs now, the general consensus is that there's more cash floating around than ever before, thanks to the run that the public markets have been on over the last since 2008, really. That's obviously changing now, but there's a lot of cash lying around. And so in theory, I think the last number I heard was there's about 80,000 accredited investors in the US with $1 million or more cash to put into, private placements, essentially.
Yeah.
But for me, I'm trying to reconcile that. If you're a venture capital person, it would make sense for you, especially in the LP context, to have a way or a method to actually tap up, 10,000 of these guys and say, look, here's what we do. Can you come on, whatever. What's your advice to finding an accredited investor with $1 million lying around?
Well, with the SEC requirements around private placement, constraints, so to speak, we can't go put an ad on Facebook and ship it all around the country. The real issue is gaining access to these folks, right? It's the issue that a founder has when they say to me that everyone could use my product or service. Well, that's a big flag for me, because you're never going to be able to create a message that is compelling enough for everyone to respond to. And so you'll lose all your money trying to market and educate your market, to reach them, and then to educate them, to get them to actually buy your product or service. Well, that same thing happens when there are 80,000 accredited investors. Is okay. How do you get in front of them? Where are they, and how do you get in front of them? Because you can't use traditional publicity and marketing practices in order to do that, or you'll run afoul with the SEC requirements. And so then you begin to use your networks. So there are a variety of ways to do that. Number one, we rely on our investors to perhaps introduce us to other potential investors, because generally accredited investors kind of hang out together. Number two, we've also backed the creation of an angel association called the Archangel Alliance, the AAA, and that is a membership association of angel investors to try to educate them and introduce them and to grow the overall investor critical mass that we have in the state and surrounding states. And then we actually do some investor education. So not through our fund, but through our entrepreneurial support organizations, we can go out and say, if you've ever wanted to invest in early stage funds or venture capital funds or angel funds or do direct angel investments, then here's some education for you that basically compels them to self-identify then. And then during that education, we can certainly tell them about the various options available, not just our fund, but other funds that are out there, the Angel Association and what have you. So it's really kind of a multi-pronged approach, if you will, that really heavily relies on our networks.
Yeah, it's great advice. Tell me, Jeff, how do you see the venture capital space evolving in the next 10 years? And what do you think its impact will be on startup founders?
Well, I think if the accredited investor requirement were lifted or altered and at least lessened, if not abolished, I think you would see a lot more people. That 80,000 people right now who meet kind of a basic criterion would probably quintuple, and there would be a lot more folks considering venture investing. I think, as long as the economy is trading sideways, or the market's trading sideways rather, and our economy is struggling as real estate prices continue to be inflated like they are here. I think that creates environments where investors are looking for alternative asset classes in order to put their money in. And so I am very much bullish on the future of venture capital. I'm bullish on the future of venture capital in the flyover states, because I think some of the coastal money is starting to see that there are some bargains to be had here. And I think it's going to create a ripe environment for founders looking to raise capital.
Jeff, what's one piece of advice let me go back. It's actually more advice for you. If you could get into the Matt Brown Show time machine and go back to yourself on day one, like no fund, you've never cut a check, and you think about all the experiences that you've had, what advice would you give yourself about investing in venture stage startups?
Don't get enamored with a slick pitch. Ask the questions to ensure they've done the work. There are so many questions today that I ask, or things that I look for, that I was just completely oblivious to. And so really, really make sure the founders have done the homework, that they've done the hard work. They haven't taken the lazy man's approach to building out their pitch deck or their pro forma. That'd be the biggest one. Don't fall in love with a slick pitch.
Yeah, that's really good advice. A slick founder.
I mean, I'll tell you, I've invested in a company where the guy who did the pitch was the CEO, but he was the lead engineer. And I saw this company twice, one in a fund that I was just an investor in, and one of the fund where I was the co-founder and general partner of. And in the first pitch, it was the lead engineer that pitched, and he had just brought a CEO on board to really lead the company. He was going to be the chief technology officer, but it was the chief technology officer, the lead engineer, that pitched, and it was horrible. It was terrible. And we really wanted to invest. We ended up investing, but it took an inordinate amount of time to get comfortable investing, because the pitch was just really bad, but the company was good. And then fast forward to the fund where I'm a general partner, and the CEO had been 6 months or so, and the CEO actually did the pitch, this new CEO who was skilled at raising money and at pitching and what have you. And it made a complete difference. There was not even a question from this investor group about whether or not we should invest in that fund. So. Well, in that company, rather.
Well, Jeff, thank you for your time, man. It's been great to get your perspective on the private placement perspective series on the Matt Brown Show. So, and also to say, like, keep doing what you're doing, man. I think, as a startup founder, multiple times, to have access to venture capital GPs such as yourself is a really important thing, and you're doing a lot of things right. So, thanks for being on the show.
You bet. I appreciate it, Matt. Thanks for having me. It's been my pleasure. And if I can do anything for any of your listeners, Jeff S., that's Jeff Standridge, Jeff S. at cadroncapital.com, CADRON capital.com.
Cool. Jeff, stick around. Thanks, everybody.